Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, and today we're tackling the S Corp topic that can either save you a pile of money or trigger a painful IRS letter, reasonable compensation. If you own an S corporation, your paycheck is not just payroll, it's a tax lever. Used correctly, it saves real money on payroll taxes, supports bigger retirement contributions, plays nice with the QBI deduction, and keeps you off the IRS radar. Used poorly, it invites reclassification, back payroll taxes, penalties, and interest. In other words, this is one of the highest impact planning areas for S Corp owners, and one where a professional tax planner can literally pay for themselves. In this episode, I'll give you a simple three-part framework to set reasonable compensation, a documentation checklist that holds up under scrutiny, and a practical playbook for blending wages with distributions. We'll walk through case studies, including a solo consultant with $200,000 of profit, an owner-operator trades business, and a multi-owner S Corp, where each partner's pay is different by design. We'll also cover QBI interactions, retirement plans, state tax issues, special scenarios like low profit years and capital-intensive businesses, and the red flags the IRS loves to see so you can avoid them. Ready to turn your paycheck into a proactive tax plan? Let's get to it. First, why reasonable compensation matters. The IRS requires S Corp owner employees who perform services to be paid reasonable W-2 wages for those services before taking shareholder distributions. If you skip wages or underpay them, the IRS can reclassify your distributions as wages. That brings back payroll taxes, penalties, and interest, and it can snowball across multiple years. Think of it this way. The IRS expects to see wages reflect the value of the work you actually perform for the business. If you're the rainmaker, the manager, and the admin, they expect your W-2 to reflect that reality. A few things that trigger scrutiny: $0 or token salaries, distributions that dwarf wages, paying family members but not paying yourself, calling owner pay, contract labor, or a pattern of paying tiny wages while you are the key worker. Another trigger, inconsistent pay patterns where you take big distributions throughout the year, then try to decide on a salary after the fact. Reasonable comp is not a suggestion, it's an enforceable standard. Do it right and you preserve the S Corp tax advantage. Do it wrong and that advantage can vanish plus penalties. The good news? There's a method to get it right, and it's not guesswork. Let's talk about the tax lever itself. Why does this matter financially? Because S Corp W-2 wages are subject to payroll taxes, Social Security, and Medicare, while distributions are not. In broad strokes, combined employer and employee FICA Medicare is about 15.3% up to the Social Security wage base for Social Security, plus 2.9% Medicare with an extra 0.9% Medicare surtax at higher incomes. Now, whether you feel both sides of payroll tax depends on your perspective. The company pays the employer share, and you pay the employee share. But if you're the only owner, it's all ultimately your money. This is why many owners try to keep salary as low as reasonably defensible and take the remaining profits as distributions. But here's the nuance. Wages also drive benefits. They can boost your retirement plan contributions. They interact with the QBI deduction. They affect state payroll taxes and unemployment. If you push wages too low, you may lose out on QBI, run afoul of reasonable comp standards, or cap your 401k contributions unnecessarily. If you push wages too high, you overpay payroll taxes and shrink QBI. The win is in the blend, right-sizing wages that are defendable, then taking distributions tied to profits and cash needs. It's not low or high, it's calibrated. Here's the simple three-part framework I use to set reasonable compensation. Part 1. Role and time analysis. List the hats you wear: revenue generation, service delivery, management, marketing, admin, finance. Estimate the percentage of time you spend in each and your total annual hours. The IRS focuses on what you actually do. Part 2. Market comparables. Price those roles based on your geography and industry. Look to sources like the Bureau of Labor Statistics, industry association salary surveys, and reputable third-party compensation studies. For many small businesses, a single title doesn't fit, so you create a blended rate based on the roles. For example, a managing partner who also sells and performs services typically commands a higher blended rate than a back-office manager. Part 3. Business ability to pay. Reasonable compensation must be considered in the context of profitability, margins, and cash flow. A startup or a year with a cyclical downturn can justify a lower salary if the facts support it. The opposite is also true. If the business is highly profitable and you're the key producer, the salary should reflect that reality. Bring these 3 parts together and you've got a defendable number that's not cherry-picked. It's triangulated. How do you triangulate the number in practice? Start by allocating your time. Suppose you work 2,000 hours a year and split as follows: 40% client service or revenue-producing work, 40% leadership and management, and 20% admin and operations. Next, pull comps for those roles in your area. Let's say market rates suggest $60 per hour for hands-on service work, $70 per hour for leadership management, and $30 per hour for admin. Your blended hourly rate would be 0.40 times $60 plus 0.40 times $70 plus 0.20 times $30 equals $24 plus $28 plus $6 equals $58 per hour. Multiply by 2,000 hours and you get $116,000. Now overlay business ability to pay. If your business is in a strong, steady state, you might choose a midpoint within a range, say $100,000 to $125,000. If you had a rough year, or you only worked 200 hours because of a mid-year start, the number adjusts down proportionally. For multi-role owners, this is the key. Price each role by market rate, allocate time, and avoid the temptation to just pick the lowest plausible number. Choose a defendable midpoint in the range. We also assign weights to the 3 factors. For example, 50% on role time, 30% on market, 20% on ability to pay. Document those weights in a memo so future you and the IRS can see the logic. That transparency matters. Documentation is your audit defense. Build a file that would make your future self proud. Here's the checklist I recommend you refresh annually. 1. A written job description that captures your roles and responsibilities. 2. Time logs or calendar entries that support your hours and how you allocate time across functions. You don't need minute by minute, but credible estimates tied to real calendars help. 3. Compensation surveys and benchmarks you relied on, BLS data, industry studies, and any third-party reports. 4. A profitability analysis showing the business's ability to pay, including unusual events like startup costs or one-time investments. 5. Board minutes or an owner resolution that formalizes your salary decision for the year. Yes, even single-owner S Corp should do this. 6. An annual review memo summarizing your triangulation method, the ranges considered, and the final salary chosen. 7. Payroll filings, 941s, W-2, W-3, and state filings, evidence of consistent pay frequency and tax deposits. 8. If you made changes mid-year, include a note explaining why, new role, new hours, profitability changes, and document the timing. This is how you move from "I think it's reasonable" to "I can prove it's reasonable." Let's talk wages and distributions, the playbook. Step 1. Set a base salary that you can defend using the framework. Step 2. Pay it on a regular schedule like any other employee. Step 3. Take distributions periodically, tied to profits and cash needs. Distributions are not payroll. They don't trigger payroll taxes, and they should be tied to the company's actual earnings and cash. What to avoid? Taking large distributions while paying little or no wages. What to prefer? Consistent wages throughout the year and distributions that come after a look at your year-to-date profit. If profits are lumpy, consider quarterly check-ins to make distributions. If the facts change mid-year, maybe you hire staff and your role shifts from service delivery to management. Update the salary and document it. If you're behind on wages late in the year, run a year-end true-up payroll to close the gap. This keeps you compliant without rewriting history. Never backdate payroll or try to retroactively label distributions as wages without amending payroll tax returns. Clean, timely, and consistent beats clever every time. Now, the solo consultant case study. One of the most common scenarios: assume $200,000 of pre-comp business profit, and you're the sole owner and sole worker. Option A, salary of $80,000. Employer payroll tax is roughly 7.65% of wages up to the Social Security wage base, so call it about $6,100 on $80,000. Your business profit after wages and employer payroll tax is about $113,900. That's roughly your QBI for Section 199A purposes, assuming no other adjustments. The 20% QBI deduction could be about $22,780, subject to thresholds and limitations. Option B, salary of $120,000. Employer payroll tax is about $9,080. Business profit after wages and employer payroll tax is around $70,820. The 20% QBI deduction would be about $14,164, again subject to thresholds. What changed? When you increase wages from $80,000 to $120,000, your combined payroll taxes, employer plus employee, generally increase, but your retirement plan options improve. With a solo 401k, your employee deferral is limited by IRS rules and your W-2 wages. The employer profit-sharing contribution is up to 25% of W-2. On $80,000 wages, that's up to $20,000 employer contribution. On $120,000, up to $30,000. If you're trying to maximize deductible retirement savings, the extra $10,000 employer contribution might outweigh the extra payroll taxes. QBI also fell as wages rose, which reduces the 199A deduction if you're under the threshold. If you're above certain income levels and not in a specified service trade or business, paying more wages can help by increasing the wage limit cap for QBI. For consultants, often an SSTB, the deduction phases out at higher incomes. In those cases, you may prefer to keep taxable income below the thresholds rather than inflate wages. Bottom line, the right salary is not just about payroll tax savings. It's the intersection of compliance, QBI, and retirement funding. A quick planning model with your advisor can quantify the sweet spot for your situation. Case Study 2. The owner-operator trades business. A plumber, electrician, or HVAC owner who is hands-on. Here, reasonable compensation tends to be higher because you are directly delivering the service that generates revenue, and market rates for skilled trades are solid. Suppose your pre-comp profits are $300,000, but half of that reflects your own billable labor. Your role time analysis might show 50% service, 30% management, 20% admin. Market comparables for skilled trades might put service work at, say, $35 to $50 per hour in your region, management at $40 to $60, admin at $20 to $30. Your blended hourly rate could easily land in the $40.55 range, which at 2,000 hours is $80,000 to $110,000. Ability to pay is strong, so landing at, say, $100,000 to $125,000 is common and defensible. Distributions can still be substantial because profits remain after salary, but the salary must reflect that you are the primary engine of revenue. From a planning standpoint, this owner often benefits from robust retirement contributions, especially a solo 401k or a safe harbor 401k if employees are present, so the higher salary also serves that goal. Case Study 3. The multi-owner S Corp with different roles. Two partners. Alex runs sales and client work full-time. Taylor oversees finance and operations part-time. Pre-comp profit is $400,000. The mistake we often see is paying each owner the same salary or the same distribution ratio. Reasonable compensation is about services rendered, not ownership percentage. Alex's role time analysis may point to a salary of $140,000, Taylor's to $70,000. That difference is not only allowed, it's the right answer. Profit distributions can still be split by ownership percentage unless your operating agreement says otherwise, but salaries should reflect role and time. This approach prevents the classic red flag where an owner doing most of the work has an artificially low W-2 while enjoying big distributions. It also allows you to plan QBI and retirement contributions owner by owner, which can be a huge win. Let's go deeper on the Section 199A QBI deduction because it's a frequent planning pivot. QBI is generally 20% of qualified business income, subject to a lot of limitations. For S Corp, wages to owners are excluded from QBI, so more wages can reduce the base for the deduction. However, for high-income taxpayers above the threshold, The deduction may be limited to the greater of 50% of W-2 wages, or 25% of W-2 wages plus 2.5% of qualified property basis. That means paying more wages can increase the cap on your deduction, useful for non-SSTBs above the thresholds. For specified service trades or businesses, think consulting, law, accounting, the deduction phases out as taxable income rises past the threshold until it's gone. If you're an SSTB near the threshold, planning might focus on keeping taxable income below it, perhaps via retirement plan contributions, entity-level SALT elections, or timing deductions, rather than paying extra wages that also reduce QBI. The takeaway: the right salary depends on where you sit relative to the QBI thresholds, whether you're an SSTB, and how wages influence both the deduction and your retirement plan funding. Your tax pro can model scenarios to find the sweet spot. Retirement plan funding is another reason to be intentional about salary. Distributions don't count for retirement plan calculations. W-2 wages do. With a solo 401k, you can make an employee deferral up to the IRS limit and an employer profit-sharing contribution up to 25% of wages, subject to overall plan limits. If your salary is too low, you cap how much you can contribute. For example, if you want to maximize employer contributions, bumping salary from $80,000 to $120,000 could increase the employer contribution by $10,000. If you're age 50 or over, catch-up contributions may apply for the employee deferral. Compare this to a SEP IRA. For S Corp owners, SEP contributions are also based on W-2 wages, generally up to 25%. The solo 401k often offers more flexibility because of the employee deferral component, especially at lower salary levels. For very high earners with stable cash flow, consider whether a defined benefit or cash balance plan makes sense. Those plans aren't for everyone, but they can supercharge deductions when paired with reasonable comp. The planning point: set salary with an eye toward the retirement target you want to hit, not just payroll tax minimization. State tax considerations matter too. Payroll taxes aren't just federal. Each state has its own unemployment insurance wage base and rates, and multi-state payroll can get complex quickly. Some states have S Corp franchise or entity-level taxes regardless of profit. If your state offers a pass-through entity tax election to work around the federal SALT cap, coordinate your salary and distributions with that election. The PTE tax is typically based on pass-through income, not wages, so salary decisions affect the base for the PTE payment and the credit you receive on your personal return. Also, if you operate in multiple states, nexus and payroll apportionment rules can alter where wages are taxed and where unemployment contributions are due. Bottom line, your salary is a multi-jurisdiction lever. Plan it with your state landscape in mind. Special scenarios call for tailored judgment. A few we see often. 1. Low profit or loss years. If the business has minimal profit and you materially participate, you still need reasonable wages for services rendered, but ability to pay can support a lower figure. Document the financial constraints. 2. Part-year or part-time involvement. Prorate salary to actual hours or months worked, and adjust your role-time analysis accordingly. 3. Capital-intensive businesses. If returns are driven more by equipment or capital than by your services, that can support lower wages relative to profit. Use comparables for supervisory roles rather than producer roles if that reflects your actual work. 4. Owners not materially participating. If you do not provide services, wages may not be required, but be careful. Answer honestly whether you provide any services. 5. Multiple entities. If you split operations and management across entities, ensure wages are paid where services are actually performed and avoid using structure solely to suppress wages. 6. Rapid growth or restructuring mid-year. Adjust salary mid-year and document the change with a dated memo and updated board minutes. The theme: match wages to facts, not to wishes. Let's hit health insurance and fringe benefits for S Corp owners. If you own more than 2% of the S Corp, health insurance premiums paid by the company for you must be included in your W-2 as taxable wages for income tax purposes, but generally not subject to FICA if properly handled. You may then take an above-the-line self-employed health insurance deduction on your individual return, subject to limits. The mechanics matter. Ensure the S Corp either pays the premiums directly or reimburses you under a plan and includes the amounts in your W-2 Box 1. As a 2% shareholder, you're not eligible for certain pre-tax cafeteria plan benefits the way rank-and-file employees are, so don't run your premiums pre-tax through a Section 125 plan for yourself. For other expenses, use an accountable plan so legitimate business expenses are reimbursed tax-free rather than run through payroll. Also consider HSAs. If you have a qualifying high-deductible health plan, HSAs remain one of the best tax-advantaged vehicles available. Just ensure contributions are made correctly. Owner contributions are typically personal, not via Section 125, to preserve the deduction. Timing and maintenance are where good plans stay good. If facts change mid-year, your role shifts, you hire staff, your hours drop, adjust your salary prospectively, and document why. If profits surge and your reasonable comp analysis supports a higher wage, consider bumping salary for the remainder of the year, rather than cramming everything into a single December paycheck. If you're short by year-end, a true-up payroll before December 31st can close the gap. What to avoid? Retroactively labeling distributions as wages after the year closes. If you missed it, the clean fix is to amend payroll returns and W-2s. Messy, but better than pretending. Also, keep an eye on payroll deposit schedules and year-end deadlines. Consistency helps. Regular pay frequency, timely deposits, and accurate quarterlies show that your salary isn't a moving target. An annual reasonable comp study at the beginning of the year with a mid-year check-in is the best practice. Here are the common red flags to avoid. These are the patterns that get attention. 1. $0 or token $1 salary while taking large distributions. 2. Distributions far exceeding wages when you're the key worker. 3. Paying family members or contractors for work that looks like your owner services while underpaying yourself. 4. Calling owner pay contract labor to avoid payroll taxes. The IRS has seen that movie. 5. Manipulating multiple entities to push wages to a low-risk entity while profits live elsewhere without a real business purpose. 6. Inconsistent pay. No wages for most of the year, then a giant distribution in December and a tiny payroll at year-end. 7. No documentation, no role analysis, no comps, no minutes, no time records. You can run a lean business, but don't run a documentation deficit. It's inexpensive insurance. Action steps to put this into practice. 1. Conduct a reasonable compensation study annually. Write down your role, time analysis, your market comparables, and your ability to pay considerations. 2. Formalize your salary in board minutes or an owner resolution at the start of the year. 3. Keep ongoing time role documentation, calendars, timesheets, or periodic summaries, so you're not reconstructing from memory. 4. Set a payroll schedule and stick to it. Build in a Q3 or early Q4 check-in to assess whether a true-up is needed. 5. Coordinate salary with retirement plan goals, solo 401k, CP, or even a defined benefit plan depending on your stage, age, and cash flow. 6. Model QBI outcomes, especially if you're near the thresholds or in an SSTB. Sometimes the best dollar of tax savings is a retirement contribution or PTE election, not a wage tweak. 7. Address health insurance and accountable plan reimbursements the right way. Don't leave easy deductions on the table, and don't turn reimbursements into taxable wages by accident. 8. Work with a professional tax planner. The ROI on getting this right is real. Reduced payroll taxes, defensible positions, optimized QBI, bigger retirement savings, and fewer headaches. Even better, you get a playbook you can repeat every year. Let's wrap it up. Today we tackled reasonable compensation for S Corp owners, the rule that your W-2 must reflect the value of the services you actually provide before you take distributions. We explored why it matters, what the IRS looks for, and how wages and distributions work together as a tax lever. You learned a simple 3-part framework, role time analysis, market comparables, and ability to pay to triangulate a defendable salary, plus a documentation checklist to withstand scrutiny. We walked through case studies, a solo consultant choosing between an $80,000 and $120,000 salary, and the trade-offs for payroll taxes, QBI, and retirement funding, an owner-operator trades business where hands-on work supports a higher wage, and a multi-owner S Corp where different roles mean different salaries. We also covered how QBI interacts with wages, how to use salary to maximize retirement contributions, what to consider with state taxes and PTE elections, and how to handle special situations like low-profit years or capital capital-intensive businesses. We talked about health insurance for 2% shareholders, accountable plans, timing fixes, and year-end true-ups, and the red flags to avoid. If you take one thing from this episode, make it this: your paycheck is a planning tool. A defendable salary paired with smart distributions can reduce payroll taxes, preserve or enhance the QBI deduction, and open the door to larger, deductible retirement savings, all while keeping you in compliance. If this episode helped you think differently about owner pay, subscribe to Tax Smarts Unlocked and share it with a fellow business owner. And if you're ready for a reasoned, numbers-backed compensation study and a proactive plan tailored to your state and industry, reach out to a professional tax planner. I'm David Robson, and this has been Reasonable Compensation, Real Tax Savings, S Corp Owner Pay Strategies that Survive IRS Scrutiny. Thanks for listening, and I'll see you next time.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.